Hi, I'm Ronnie. Today I want to walk you through one company in our portfolio, Ciena. Ciena builds the equipment that moves internet data across fiber optic cables. Picture the long glass lines that carry data between cities, across oceans, and between large data centers. Ciena's gear sends that data as fast pulses of light. Why does this matter right now? Artificial intelligence. Training and running AI models means moving enormous amounts of data between data centers. That traffic has to travel somewhere, and it travels on optical networks. Cloud providers are buying this gear faster than before. Ciena sits right in the middle of that demand. So this is a company tied to one of the biggest shifts in technology today. Let me show you our position. Here is what our position looks like. This chart shows Ciena's share price over the last 3 months. The flat line marks our average entry, near $477 per share. As you can see, the price sits close to where we bought it. The position is roughly flat since entry. That is past performance, not a forecast, and a few months is a short window. One point I want to be clear about. This is a single stock. Our nightly risk system manages the whole portfolio's exposure to the market. It does not protect any one name like Ciena on its own. What helps us here is different. Ciena is one of many equal weighted positions, so no single holding carries the book. We hold it for the business behind it, which is what the next charts show. Now to why we own it. This chart shows two things together. The bars are Ciena's revenue each quarter. The lines above them are two profit measures. The first is gross margin. That is the share of each sales dollar left after the direct cost of building the product. The second is operating margin. That is what remains after the day-to-day cost of running the business, before interest and tax. Look at the shape. Revenue has climbed steadily, from about $1.1 billion a quarter to roughly $1.6 billion. At the same time, the operating margin line has widened sharply from around 3% a year ago to about 15% in the latest quarter. Gross margin has held in the low to mid-40s. So Ciena is not just selling more, it is keeping much more profit from each sale as it grows. That combination matters. A company can grow revenue by spending heavily and earning little. Here, growth and rising profitability move together. That is the kind of quality our screening process looks for. Real revenue growth backed by improving margins. Here is a second piece of evidence. This chart tracks the average analyst forecast for Ciena's earnings per share. Earnings per share is the company's yearly profit divided across all of its shares. The forecast here is for fiscal 2027, the next full year, which ends in late 2027. The line covers the last 90 days. Notice the direction. Over those 3 months, the average estimate has climbed about 17% to roughly $9.64 per share. That is up from about $6.54 expected for this year, a jump of nearly half. And in just the last 30 days, 17 analysts raised their forecast, while none cut it. When many analysts lift their numbers at the same time, it usually means the business is doing better than they expected. We pay attention to this because rising estimates often come before rising results. Our process weighs the direction of these revisions when it decides which companies qualify. For Ciena, that signal has been pointing up. Now, the honest part, the risks. Ciena trades at a rich valuation. Its forward price to earnings ratio sits near 50 times against about 33 times for its direct competitors. In plain terms, you pay a high price today for each dollar of expected profit. The market already expects strong growth, so a lot of good news is priced in. If AI-driven orders slow or a big customer pauses spending, the stock could fall hard. A high price leaves less room for disappointment. We do not ignore that. Our systematic screen has no fixed valuation limit, so it can own expensive winners. But expensive is never the same as without risk. Two things keep this in check. Ciena is held equal weight as one of many names, so it cannot dominate the portfolio. And every month we recheck whether it still qualifies. If the story breaks, it can drop out at the next rebalance. So here is the takeaway. We own Ciena for clear reasons: real growth, improving margins, and rising forecasts in a company wired into the AI build-out. We hold it with our eyes open on the price. That is our deep dive on Ciena. If you would like to follow how we build and manage this portfolio, you can copy AlphaWizzard on eToro. To be clear about how that works, we invest our own capital, and if you choose to copy, eToro replicates our trades proportionally in your own account. You stay in control of your account at all times. Two veterans, more than 40 years of combined experience running a data-driven process. One last and important note: past performance is not an indication of future results. Your capital is at risk. Thanks for watching.